Hello everyone and welcome to Financial Accounting. In this video, we will analyze one more business transaction using the Integrated Financial Statement Framework. We will look at the revenue transaction. An Integrated Financial Statement Framework is very helpful to those who are relatively new to accounting. It demonstrates the impact of transactions on the balance sheet, income statement, and the statement of cash flows, and the corresponding relationship among these financial statements. If you would like to learn more about the basics of the Integrated Financial Statement Framework, I have a video that goes over the details. I am posting the link here and in the description below. The accounting equation is the basis for the framework. It is expressed as follows: assets equal liabilities plus stockholders' equity. Now, let's look at the revenue transaction. The company received $52,000 in cash from fees earned. Fees earned is a revenue account included in the revenue section at the top of the income statement. The fees earned account is most used in the services industry, for example, in tax consulting, auditing, and general consulting. If the reporting entity is operating under the cash basis of accounting, the amount reported as fees earned would be the amount of cash received from the customers during the reporting period. Alternatively, the account contains the amount of fees earned during the reporting period, regardless of the amount of cash received from customers, if the reporting entity is operating under the accrual basis of accounting. Also remember that when we talk about cash, it is not just cash in bills and coins, but also bank balances, money orders, and checks. If you would like to learn more, watch my video Financial Assets, Cash, Short-Term Investments, and Receivables. I'm posting the link here and in the description below. Cash flows from operating activities refer to the cash inflows and outflows related directly to the revenues and expenses reported on the income statement. Therefore, when $52,000 is received for services, this transaction increases cash from operating activities by $52,000 under the Statement of Cash Flows column. Under the Balance Sheet column, cash will increase by $52,000. An increase in revenue will increase retained earnings by $52,000. Note that revenue is a part of retained earnings, which is, in turn, a part of stockholders' equity. After this transaction, the balance in cash is $192,000, and the retained earnings balance is $52,000. The balances of notes payable and capital stock remain the same. Under the income statement column, fees earned are reported as a $52,000 increase in revenues. Now let's see whether the accounting equation for this transaction balances. $52,000 in assets is equal to $52,000 in stockholders' equity. The accounting equation for this transaction balances. Let's also look at the totals. The first transaction was to record the owner's initial investment in the business. We recorded it as an increase in cash, which is an asset account, and an increase in capital stock, which is a stockholders' equity account. The second transaction was borrowing. We recorded it as an increase in cash and an increase in notes payable, which is a liability account. The totals for all these transactions are $192,000 in assets, $40,000 in liabilities, and $152,000 in stockholders' equity. $152,000 equals to $100,000 in capital stock plus $52,000 in retained earnings. The accounting equation balances. Another built-in control that helps you ensure transactions are recorded correctly is verifying that the ending balance in cash on the statement of cash flows equals to cash balance on the balance sheet. In our example, both the ending cash on the statement of cash flows and on the balance sheet is $192,000. I hope you found this video helpful. If you did, please subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.